Hey there, and welcome to my channel, the Paper Bag Investor. Today's video, I want to talk about Lemonade. I want to give some quick thoughts, first of all, on the stock market crashing and how that relates to Lemonade, and sort of one tip around that area. But I want to spend most of this video looking at a new 5-year projected value for Lemonade that I've redone since their earnings. And then I also want to explain what I'm doing with Lemonade going forward, what's my strategy around this stock. So let's get into it. And before I go any further, just want to make it really clear, I'm not a personal financial advisor. Just a guy with a paper bag on his head who loves investing, loves thinking about the future. And if you get value out of this video, I encourage you to hit that subscribe button. But again, not a personal financial advisor, just a guy I've been investing since about 2008, 2009, and love to learn and want to continue to learn. So if that appeals to you and you get value out of this, again, hit that subscribe button. I think you'll get value out of my future videos. Okay, so let's get into it. First of all, I want to touch on, the stock market has been really horrible a couple weeks here, especially if you're a Lemonade investor like myself, like you guys who are watching this. My quick tip, if you're feeling stress about the stocks you own, especially as like myself as a long-term investor, if you're feeling any anxiety about the stocks that you own, as the market is going down, really then my suggestion is to sort of double down on your own due diligence and research. Reestablish what I call that conviction. If you have conviction behind the companies that you're buying in the first place that you did buy, then as the price falls, really you kind of double check your own conviction that your conviction's still there. It gives you the strength to buy more of that stock, maybe if it's at a discounted price. I also want to quickly say, I think the previous estimate I did for Lemonade for a 5-year target was too enthusiastic, especially around their customer growth. I still think the growth story is there for Lemonade, but my thought, I thought the customer growth would be more explosive going forward, and like geographic growth, growing. And this was sort of a question I asked the CEO before the earnings call, and he touched on that in the earnings call, basically saying that if you see my other video, you've seen me talk about this, but he basically said that they're trying to optimize overall in-force premium and gross earned premium, and not so much the actual customer base. Which, it makes sense, and they have detailed models that they're making. They're evaluating where they're spending exactly dollar per dollar, and so I trust that these models are excellent models. They're refining over time. I just wonder, though, I would have thought that really pushing for geographic expansion, the advantage of that is that even if you're just getting renter's insurance, all renters who are buying cheap insurance all across Europe, at least there's a word of mouth spread when you're spreading to more and more people. Actual quantity of customers have word of mouth spread, and of course, how much is that factored into their model or not? Obviously, if you're making decisions based on a model, then your decisions are only going to be as good as your model. So obviously their model I trust is great, and what he said makes sense. But I've been thinking about this more. I just wish in my mind, I wish they were pushing for more customer growth. But it seems they're more centered around just the in-force premium growth, which makes sense. That's what you really care about. But I wanted to touch on that. So let's get into that 5-year. And in this 5-year projected value, I actually, rather than trying to project out the customer base, because they basically said they're not trying to just necessarily just grow the customer base, I've just projected out the gross earned premium. And I actually, in one of my other videos, I was explaining gross earned premium, and I realized I was misunderstanding it at that point in time, because just the way the math worked out, my definition I was using kind of made sense with the numbers. But I wanted to explain what it actually is here. So gross earned premium is the earned portion of our gross written premium. So this would be essentially, they have in-force premium is how much money at a certain date or a certain time, how much money is actually being carried, or how much premium is written for all the customers that have their insurance plans with them. So that's your in-force premium, is all that amount. But then their earned premium is when the the date or the set time for that insurance package, say it's a year long, renter's insurance or pet insurance or homeowner's insurance or whatever it is, once that expires, in every quarter that expires, then they count that money as gross earned premium. So it's kind of trailing the in-force premium as that grows, probably on a kind of a 12-month basis. The gross earned premium is trailing that. So that's really what your gross earned premium is. And then the gross loss ratio is, I just want to touch on that as well because we're going to use that in this calculation, is the ratio of losses and loss adjustment expense to gross earned premium. So it's a ratio of how much you're losing to what the gross earned premium is, or what you're counting as earned for that in that quarter. And of course, your losses then would actually be your gross loss ratio multiplied by your gross earned premium, which we're going to use that to calculate. So I wanted to touch on that and clarify that, something I had learned in the last few days, okay? So this 5-year projected value, these are some historical data for the gross earned premium. You had in millions, 25, 75, or 76, 159, and they're projecting for this year around the $275 million mark. For the entire year to bring that in. And the year-over-year ratio, when you're looking at this, so this basically tripled. There's like an almost 3x increase, and then 2.1x increase, so like 110%, and then like a 73% jump from there. So I kind of projecting forward into the future, their gross earned premium, I'm going to guess like, maybe next year, the year after, they do 70%, and then maybe 70% again. Maybe it's declining. They get to like 165% increase, and then a 60% increase. And to that point, that'd be like the end of 2025, so about 5 years from now would be like the $2 billion of gross earned premium. Again, these are millions, so 2,000 millions is 2 billion. And the example you could think of that is like if you had 5 million customers, each with like $4,000 or $400 each annualized as sort of an average. That would get you to your 2 billion. So that seems pretty reasonable if they keep expanding. Like that seems pretty doable. Might even be conservative. Maybe they keep growing 70. Maybe they have a bigger year. But that gets you that sort of 2 billion range. And of course, I'm hoping Lemonade, they can just keep on scaling as an investor, that if you look from 2025 to 2030, maybe they could go from right now, they're at that sort of in that $200 or 200 million range to 2 billion range. I hope they can go 10x again to 20 billion. And then maybe, 5 years by 2035, maybe they're at the $200 billion kind of range. So it just depends how they can grow and scale that. Okay, and then we're going to look at, their insurance losses for this year. I'm just using a gross loss ratio. This is roughly where they're at. I'm going to assume they just sort of level out at 70%. Obviously, this ratio is going to fluctuate if there's like any kind of natural disaster. This could go higher than this, but also could average out lower than this as their products mature. But so I just calculate based on these numbers, and that what we had defined as the gross loss ratio. You get their insurance losses, 100 and some million, 359 at 1.4 billion dollars of insurance losses. And then operating costs, I also just projecting that out into the future. Again, pretty simple calculations, but historical data, they had about 120 million, and then last year 146 million. That's like a 22% increase. It's kind of roughly what they've been increasing. So again, I just kept in scaling every year about a 22% increase. So it went from 146, 178, boom, 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 boom. You're at almost $400 million. Obviously, this is a growth company. How they plan to execute, you grow your earnings are growing at a faster rate than your operating costs as you scale your operations. So I think this could be reasonable. Maybe at that $400 million mark. And so then you can kind of project out your net income. And again, this, I want to be clear, this doesn't actually include, I'm ignoring the reinsurance. So I want to do another video on how the reinsurance is structured and how they might change that over time. But I'm completely ignoring reinsurance, assuming that this is like eventually they're going to reach a steady state where they have no reinsurance. So we're just looking at it like that. And they give values like a gross earned premium, which do not include reinsurance for that reason, so that investors like us can understand kind of their business aside from the reinsurance protection. And again, I've mentioned that in other videos. They're using reinsurance because they're growing as rapidly as they can. And as a growth insurance company, you don't want to not be insured yourself, grow too rapidly, and then your insurance models maybe aren't good enough, or you grow too much and there's a disaster, and that could be catastrophic for your company. So they're using that reinsurance to protect themselves as they grow aggressively. But again, in this, I'm just ignoring it as if there was no reinsurance happening. Of course, I think in 5 years there'll still be reinsurance on at least some of their products. But okay, so then you get kind of a net income if you subtract we're going to subtract the gross earned premium from the losses. You get 2 billion minus 1.46 billion, and then minus another 400 million here. You get a net income of maybe like 235 million in that range. Now I'm giving a ratio. Again, we're not taking taxes off, not worrying about any of those other details. We're just taking this sort of net income and giving a ratio for that of a market cap to operating incomes in the future. And I'm saying if they're still growing, if they're like, 5 million customers, we could have 50 million or 500 million customers, like there's going to be a very high ratio assigned to this value. So I'm giving it a 50 on this sheet, but it could be higher, could be lower. And again, there's no reinsurance in there. So obviously the reinsurance numbers could look very different. How that actually looks of the actual revenue, actual net income could be much lower still. But I'm giving it sort of a 50 ratio here. And right now, that would give you them like a market cap of somewhere like 11 billion at that point. And we're going to play with these numbers in a moment here, show you. But right now they're like a $5.5 billion market cap. So yeah, the numbers to me are not fantastic because I thought the growth, I just wish they were like even growing higher, like these first baseline numbers. I wish were I wish this was like, 20 million customers of 400 each, and this was 4 times the amount. But what they're kind of projecting for this year and what we've seen, this is probably more realistic. You get that to like 11 billion market cap, and right now they're at like 5.5 billion. So that's like a 2.1 increase and a compound annual growth rate over the next 5 years of 16% year over year. So, but if they're still in that growth mode, which they totally will be, this could be higher. Like if this is 100, I'm just going to type in as 100 for this, then you get like much higher. You're kind of at like a 33%, which is just like, that's a fantastic investment from today's price, especially after this decline in price. Just fantastic. So, it just depends where the market evaluates them. But I'm typing in like, I think it could be a 50 at that range. But obviously time will tell. If it's something lower, like 30, then you're only going to get like, maybe the stocks, you probably could say it's overvalued right now. Someone would argue then, because it's only going to grow 5% year over year for the next 5 years. But again, it's just how you play with the numbers. I put in 50, I think, as a more realistic, which is 16%, which is still a very, very fine investment with room for upside, because the market might view it at this time as, a really, really still like high growing company. Like honestly, it could have like a P of like, this could be like in the hundreds at this point. And then you could have, it might 8x in the next 5 years. So really could change that. It just depends how the market sees it and how much they actually grow. But I'm thinking more realistic is like maybe somewhere in this range, which is still not bad, and you're still holding still 16% year over year with potential higher upsides. Again, still not bad. So that's kind of my 5-year projection, and now I want to touch on what are my current thoughts on how to invest in Lemonade, or what to kind of do with it. So I'm also kind of thinking, again, in that spreadsheet, there was no reinsurance whatsoever. I'm assuming that they're going to slowly phase out reinsurance over time, but the reinsurance is going to affect the actual numbers we're seeing. So I'm thinking Lemonade could. It might be a stock. It's a stock I'm going to watch. I'm going to keep reporting on, keep giving you guys videos on, and watch very, very closely, because I think all the qualities of Lemonade are just excellent qualities that could make it a huge company over time. But I'm wondering if the market might just not understand it well over the next few years. And there might be just like it's a stock to watch very closely, because if it's misunderstood in a few years' time, it could be severely undervalued. And it could be that's, to me, that's when I would dump in a large part of my portfolio. If in like 3 years, the reinsurance is like starting to phase out, but it's not affecting their actual baseline numbers, and maybe they're growing even better than I thought, and the market's still giving them a pretty good multiple, and they still have, aggressive plans to aggressively grow, then at that time I would probably invest big. Right now, I'm holding on to my shares. I own a decent chunk of my portfolios in Lemonade, not a crazy huge amount, but I'm gonna hold those shares and maybe accumulate some, especially if it stays in this lower range here. But that's kind of my thoughts going forward, is watch it closely, because I feel like it's misunderstood, especially around this reinsurance was part of it. And then if it's still misunderstood in a few years' time, and they're still executing well, still growing, it could be a tremendous opportunity. Not exciting for here and now and today, but those are my thoughts on Lemonade and my sort of projection going forward. So I'd love to hear what you guys think. Let me know in the comments down below. If you got value out of this, please hit the subscribe button, and I'll be doing more videos. And hit the thumbs up. Appreciate that as well. Helps the YouTube algorithm. Okay, but I'll see you in my next video. Thank you so much for watching. Cheers.